welcome to a special edition of the Global Mobility Minute. I'm Grant Euler, and today we ask the question, what is the difference between tax equalization and tax protection? Here's Kerry Weinger with the answer.
Thanks, Grant. We get this question a lot. Tax equalization, like tax protection, compensates assignees for the additional home and host country tax costs resulting from an assignment. The goal of tax equalization is to keep the assignees tax neutral, meaning the assignees pay no more or no less tax during the assignment than they would have paid if they had remained at home. On the other hand, with tax protection, the employer assures the assignees that they will not be put in a worse off tax position as a result of the assignment. That is, they won't have to pay more in taxes. So if the assignees are sent to a higher tax country, they will be reimbursed for the extra taxes. If the assignees go to a lower tax country, the employer often pays nothing and the assignees benefit from the reduced tax. Let's illustrate with an example involving a U.S. assignee sent abroad for 3 years. Under tax equalization, the employer calculates an estimated hypothetical tax on equalized income. This estimated hypotax is the tax that would have been paid if the employee had stayed home, and the calculation is done before the assignment begins. The employer deducts a portion of this hypotax from the assignee's compensation each pay period during the assignment and uses this money to pay the employee's actual taxes during the year. In the example shown here, the estimated hypotax is $12,500. At year end, the employer will calculate a final hypothetical tax, taking into account any additional taxable events that may have occurred during the year. If the assignee's final hypotax is less than the hypotax deducted from pay during the year, the employer will reimburse the assignee for the difference. However, if the final hypotax is greater than the amount of the hypo deductions during the year, the assignee is responsible for the difference. In this example, the assignment is to a high tax country. Let's say Sweden. In addition, the U.S. assignee received an unexpected bonus during the year that increased the hypotax liability, so that the final hypotax is now $30,000, not the $12,500 estimated at the beginning of the assignment. This results in the assignee being responsible for the $17,500 in additional hypotaxes, and to the employee's surprise, being asked by the employer to write a check back to the company. Now, let's assume the U.S. assignee is sent to a low tax country, let's say Hong Kong. And instead of tax equalization, the employer uses tax protection. While it's possible to be done, tax protection usually does not involve deducting a hypotax. In this example, the assignee's tax returns are prepared at the end of the year and show combined actual U.S. and Hong Kong taxes of $10,000. Meaning the U.S. assignee gets a windfall of $20,000 over what would have been paid had the employee stayed home. Said another way, if the assignee had not accepted the assignment, the employee would have paid out-of-pocket taxes of $30,000. But here, because of tax protection, the employee is only out-of-pocket $10,000. This results in a tax benefit to the employee of $20,000.
Thanks, Kerry. For more information on this topic and other mobility topics, please visit Baker McKenzie's webpage. I'm Grant Euler, and this has been a special edition of the Global Mobility Minute.